Hi all, welcome to this tutorial. In this tutorial, we are going to discuss about the component of income statement. So this is a lesson from External Financial Reporting Decision from CMA USA Part 1. So the key learning objectives of this lesson is to explain the purpose of income statement. The key purpose of income statement we discussed even previous session also is to see the financial result of a business process or of a company, whether it is generated a profit or loss. Then identify the key component of an income statement. And calculate gross profit, operating income and net income. And distinguish between operating and non-operating items. Also, use income statement information to evaluate business performance. So this is the key learning objectives of today's discussion. So let's get started. Let's start with the purpose of income statement. What is income statement? Income statement is show a company's total income and expenses for a period of time. So the key purpose of income statement to see the financial result of the company, whether is the company's generated profit or loss. So it summarizes the total revenue and expenses over a period of time. It answers a key question. Did the company earn a profit during a period? So this is a key question that will answer by the income statement if the company made a profit or loss during a period. So unlike the balance sheet normally is showing for a specific point of time, but when it comes to income statement, it is showing for a specific period of time. Suppose it's for a balance sheet. If it is a balance sheet, it is showing a specific date, maybe 31st December 2024. But when it comes to income statement, it's showing for a period of time. It is starting from a starting date to an ending date. Suppose 1st January 2024 to 31st December 2024. It's shown for a period of time. So the key purpose of income statement is to evaluate the profitability and help in the cost control and to evaluate the operational efficiency. The key basic formula of income statement is all revenue minus total expenses. That is the formula for net income. If the revenue exceeded total expenses, that will create a net profit. If the expenses exceeded the revenue, that will create a net loss. What is revenue? Revenue represents the revenue, or what we call as sales, represent the income generated from a business activity. Suppose if a company focused in the subscription business or any other type of business, the key revenue or sales generated from the business activity that we called as revenue. And the expenses, what is the expenses? Expenses represent the cost incurred to generate the revenue. Revenue means it is the income generated for the business activity. There should be some cost to generate this revenue, that what we called as expenses. So key component of income statement. A typical income statement includes the following activities. First one is the revenue or the total sales. Then the cost of goods sold. Cost of goods sold means it is a direct production or purchase cost. Then the gross profit. Gross profit means is total revenue minus total cost of goods sold. That is gross profit. Then the operating expenses and the operating income. Operating income means gross profit minus all operating expenses. Then the non-operating items and the net income. So here the revenue means income from primary business activity. Suppose if a business focused in a software development, so the total income generated from that software development, that is coming under the revenue. Then the cost of goods sold. That means that is the software development cost. That is cost of goods sold. Or in the case of a software company, then the gross profit. Gross profit means total revenue minus total cost of goods sold. That is gross profit. Then the operating expenses. So besides the software development costs, there can be some other operating costs as well, such as selling expenses, administration expenses, and this type of expenses what we called as operating expenses. Then the operating income. If you reduce these all operating expenses from the gross profit, then we will come up with the operating income. Then the non-operating item. Non-operating item means those items which is not directly linked with the business activities, which is not directly linked with the software sales. Suppose there are some excess cash in the business. So that cash is invested somewhere. So this income is not directly related with the business activity, but this is an income. So this type of income we call as non-operating items. Then if we adjust these all non-operating items, then we will come with the net profit. The net profit means it is a final profit after adjusting all the cost, like the cost of goods sold, operating expenses. Even non-operating items also will adjust before the net income. So the first one is the revenue. Revenue represents the income earned from a company's primary activities. Example include sale of product, service income, subscription revenue. Revenue is usually reported at the top of the income statement. The first line in the income statement is revenue. Then the cost of goods sold. Cost of goods sold include direct costs associated with the producing goods sold. Typical manufacturing cost include direct material, direct labor and manufacturing overhead. So this is the direct cost associated with the producing that goods sold. Or in the case of a trading company, all direct costs associated with the purchasing that goods. Suppose the purchase price plus the freight, storage, all these things will add up with the cost of goods sold in the case of a trading company. But in the case of a manufacturing company, which will add direct material, direct labor and manufacturing overheads. The formula for cost of goods sold is beginning inventory plus purchase minus ending inventory. So then you will end up with the cost of goods sold. So cost of goods sold directly affect the company's gross profit margin, because from the sales we are deducting cost of goods sold to calculate the gross profit margin. The third component is gross profit. Gross profit measures the profit remaining after the production cost or after the cost of goods sold. The formula for gross profit is revenue minus cost of goods sold. Gross profit indicates production efficiency and pricing strategy. So if a company have a good gross margin or gross profit, which indicate that the first thing is its good pricing strategy and its production cost or its purchase cost. All this will affect with the gross profit. Then the operating expenses. Operating expenses, all those expenses which can be incurred to run business day-to-day activity. To run day-to-day business activity, there are some expenses that what we call as operating expenses, like advertising, sales commission, office salaries. All these come under the operating expenses. So operating expenses are those expenses which is directly incurred to run day-to-day business activities. Then the operating income. Operating income means from the gross profit, if you reduce the total operating expenses, then you will end up with the operating income. So with the operating income, we will cover with the first thing, it is cost of goods sold, then the operating expenses. The operating income formula is gross profit minus operating expenses. Operating income also called as EBIT, that is earning before interest and tax. So with the operating income, you can measure the operational efficiency of a company. That means how the company overall operational efficiency, how the cost control metrics are working, what is the price point, how about the pricing strategy, and what about the total cost control, and what about the total purchasing cost control. All these things we can measure with the operating income level. Then the non-operating items. The non-operating item typically include which is not all the item which is not directly related to core business operations, like the cost of borrowing, which is not directly linked with the business operations. Then the interest income. If there are some excess money we invested in some investment opportunities, which will not come under the operating item, so which is a non-operating item. Then the gain on sale of asset. Is there any gain company made on sale of asset? That will also come as non-operating item. Then the loss of sale of asset. If a company sold a asset on loss, this will also come under the non-operating item. So the non-operating item in all the item, or whether it is income, gain or loss, which is not directly related with the core business activities. Then the net income. Net income is the final measure of profitability after covering all revenue and expenses are considered. In the net income, all revenue and expenses are considered, whether it is operating, non-operating, cost of goods sold, everything is considered in the net income. Net income commonly referred as the bottom line. So the common formula for the net income is operating income. After the operating income, you have to adjust all non-operating items, whether it is gain or loss. All this has to be reflected before the net income. So the net income is the final bottom line or final profitability after all revenue and expenses. So here you can see an example for an income statement. So here the revenue 600,000. After revenue, we adjusted the cost of goods sold. That is 380,000. Then we come up with a gross profit 220,000. That means 600 minus 380. That is gross profit. Then the total operating expenses 150,000. So to get the operating income, we reduced 150,000 from 220,000 to get the operating income. So with the operating income level, we are considered all the cost of goods sold and all operating expenses in the operating income level. So after there are some interest expenses and taxes that are also subtracted to calculate the net income. So the interest expenses and taxes are normally considered as a non-operating expenses. Is there a non-operating income are there like a gain on sale of an asset? This has to be added before the net income. Suppose two companies report identical net income. Company A has higher gross profit and company B has lower operating expenses. Which company likely has better production efficiency? So when it comes to the production efficiency, it is mainly related with the growth, which is measuring in the gross profit level. If you control the cost in the production level, which will reflect in the gross profit, not in the operating profit. So the company here, because higher gross profit suggests more efficient production or stronger pricing. So in the gross profit level, which is measuring the production efficiency or purchase efficiency or the pricing strategy. When it comes to operating income, it is reflect all these things which is reflected in the gross profit plus the operational efficiency as well. When it comes to income, net income level, which is reflecting everything, which is include the cost of goods sold, operating expenses, even non-operating expenses also reflecting in the net profit level. So it is very important to understand this structure to evaluate a financial performance, like what are the key components included in the gross profit level and what are the key components which is reflected in the operating income level and what are the components which is reflected in the net income. So understanding this structure is very important to evaluate a financial performance and an income statement performance. So let's move into the question, multiple choice question. A company report sales revenue 800,000, cost of goods sold 500,000 and the operating expense 200,000. What is total operating income? So it has to be 800 minus 500 minus 200. So in this case it is 100,000. So in the operating profit, operating income, the cost of goods sold and the operating expenses also has to be removed from the total sales revenue to get the operating income. Then question 2, which of the following is classified as non-operating expenses? Advertising expense, office salary, interest expense and rent expenses. So in this case the non-operating item is interest expenses. Interest is normally classified as non-operating expenses. All other expenses, advertisement, office salaries and rent, all classified under the operating expenses. So here the non-operating category item is interest expense. So interest expense is related to financing activities, not a core operation. So before winding up this discussion, let's have a quick summary. So what we discussed today is about the income statement. So income statement measure the financial performance over a period. Income statement is measure a financial performance of a company during a period of time. The key component of income statements are revenue, cost of goods sold, then we will end up with the gross profit. Then after we deducting the operating expenses from the gross profit, we will end up with the operating income. Then we will adjust all non-operating items, then we will end up with the net income. So the key profit measures are the gross profit, and the gross profit, the formula is revenue minus cost of goods sold. Then the operating income, the formula is gross profit minus all operating expenses. Then the net income, for the net income formula is operating income minus all other non-operating items like the interest, taxes, or gain or losses on sale of fixed asset. All these will reflect in the net income level. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.